Learning outcomes. After studying this module, you shall be able to gain an insight about the foreign exchange market and how trading is carried out in this market. Understand the process of forex trading, analyze the meaning of arbitrage and the various arbitrage strategies used in the forex market. Explain how governments use direct and indirect intervention to influence exchange rates. When we travel abroad, we have to exchange our domestic currency for that of the country we are visiting. For this purpose, we make use of exchange rates. An exchange rate is the rate at which one country's currency can be converted into another. Exchanging currency isn't just for travelers. The price difference is something you can trade. In the global economy, thousands of business transactions takes place every day that require organization to exchange the value of one currency for that of another. When a United States automobile manufacturer buys steel from Japan, he needs to convert dollars to yen to make the payment. In every exchange, prices need to be adjusted because one currency is typically weaker or has less value, while the other is stronger, that is, has more value. A decline in a currency's value is referred to as depreciation. Similarly, an increase in a currency's value is referred to as appreciation. For example, yesterday the exchange rate was $1 is equal to rupees 60, and if today's exchange rate is $1 is equal to 62 rupees, this means that the rupee has fallen in value or depreciated and the US dollar has risen in value or appreciated, because now you have to pay more rupees to purchase same amount of dollars. Throughout the course of the day, the value of one currency compared to another can change in response to political news, economic condition and interest rate changes. These frequent changes in the value of currencies drive the foreign exchange trading and a trader's profit potential in the currency market. Let us understand two important trends in the market. The first is a bull market. A bull market is a market in which prices are rising or expected to rise. It is characterized by optimism and investor confidence. Bull markets offer investors opportunity to earn profits by buying financial instruments at a lower price, closing their position, selling at a higher price. Bear market. A bear market is a market in which prices are falling or are expected to fall. It is characterized by pessimism, continuous selling, which further pushes down the prices. Bear markets offers traders opportunity to sell at a higher price and close positions by buying at a lower price. In a bear market, traders sell to exit the market and minimize losses. Although many financial products have restriction on selling to capitalize on bear market opportunities, forex does not have these restrictions. Foreign exchange market. The foreign exchange market is very big. Unlike the stock and bond markets, forex market is open 24 hours a day and 5.5 days a week. It is the most traded market in the world. In the forex market, one currency is always strengthening against another, called bullish, and therefore one currency is always weakening against another, that is bearish. Because of this, you have equal opportunity to buy or sell to enter the market. So, if the US dollar or the USD is strengthening against the Indian rupee or the INR, it implies that INR is weakening against the USD. Forex trading. In foreign exchange or currency trading, traders hope to generate a profit by speculating on the value of one currency compared to another. This is why currencies are always traded in pairs. The value of one unit of currency doesn't change unless it is compared to another currency. Currency pairs. A currency pair tells us how much of the quote currency is needed to purchase one unit of the base currency. For example, currency pair could be the Euro USD, which is 1.33820. This is the sample quote for this pair. The first currency listed is called the base currency. The second currency is called the quote or the terms currency. So, in this case, 1 euro is worth approximately 1.33 USD. Two trade opportunities. Scenario 1, which is buy trade. If a trader believes that the euro is bullish against the USD, that is, the euro is strengthening against the US dollar, then he or she may enter a trade to buy euros expecting to gain from the stronger value of euro compared to the US dollar. The second scenario is sell trade. Conversely, if a trader believes that the euro is bearish against the US dollar, that is, the euro is weakening against the USD, then he or she may enter a trade to sell euros in the hope that the currency's value will become weaker compared to the USD. Currencies traded in the forex market. Traders can trade almost any currency depending on the currency pairs offered by the dealer. Although some retail dealers trade exotic currencies like the Thai baht or the Sek Korna, the majority trade the 8 most liquid currencies in the world, which are the US dollar, Canadian dollar or the CAD, euro or EUR, British pound or GBP, Swiss franc or CHF, New Zealand dollar NSD, Australian dollar AUD, Japanese yen JPY. Pips, lots and leverage. What is a pip? Pip stands for a percentage in point and is the smallest measure of change in a currency pair in the forex market. In the forex market, currency pairs display their prices with 4 decimal points. The change in that 4th decimal point is called 1 pip. Among the major currencies, the only exception is the Japanese yen, which displays 2 decimal places. A pip is a standardized unit and is the smallest amount by which a currency quote can change, which is usually $0.0001 for US dollar related currency pairs, which is more commonly referred to as 1/100th of 1% or 1 basis point. This standardized size helps to protect investors from huge losses. For example, if a pip was 10 basis point, a 1 pip change would cause more extreme volatility in currency values. Since a pip is a very small measurement unit, you may wonder how forex trading can be worthwhile by speculating on such a small fraction of a currency. The answer is that since forex is traded in large volumes called lots, the pip value also gets multiplied. The higher the volume you trade, the more each pip will be valued. This will be clear after studying the following illustration. Suppose the USD/euro direct quote is 0.9246. This quote means that for $1 you can buy about 0.9246 euros. If there was a 1 pip increase in this quote, that is to 0.9247, the value of the US dollar would rise relative to the euro, as US $1 would allow you to buy slightly more euros. The effect that a 1 pip change has on the dollar amount or pip value depends on the amount of euros purchased. If an investor buys 10,000 euros with US dollars, the price paid will be US dollar 10,815.49. That is 1 by 0.9246 into 10,000. If the exchange rate for this pair experience a 1 pip increase, the price paid would be $10,814.32, that is 1 over 0.9247 into 10,000. In that case, the pip value on a lot of 10,000 euros will be US $1.17, that is $10,815.49 minus $10,814.32. When the same investor purchases 100,000 euros at the same initial price, the pip value would be 11.7 US dollars. As this example demonstrates, the pip value increases depending upon the amount of the underlying currency purchased, in this case euros. What is a lot? In forex, a lot is a standard unit of measurement. At most forex dealers, one standard lot usually equals 100,000 worth of currency. What is leverage? One of the benefits of foreign exchange market is the ability to trade on leverage. Leverage is necessary in this market because the price deviations, that is the source of profit, are merely fractions of a cent. Leverage, expressed as a ratio between total capital available to actual capital, is the amount of money a broker will lend you for trading. For example, a ratio of 50:1 means your broker would lend you $50 for every $1 of actual capital. So you don't need $10,000 in your account to trade the Euro USD. This means you can control a large position, $10,000, with a small amount of money, $200. Although the ability to earn profits by leveraging is substantial, leverage can also be risky and may work against the investor. For example, if the currency underlying one of your trade moves in the opposite direction of what you believed would happen, leverage will greatly amplify the potential losses. To avoid such a catastrophe, forex traders usually implement a strict trading style that includes the use of stop and limit orders. Stop and limit orders in the forex market are used by investors in the same way as in the stock market. Limit order is one that is generally placed on the better side of the market, and it is always the trader's intention to get the limit price or better on such an order. So, buy limits are placed below the current market price and will only be filled at or below the limit price. Sell limits are placed above the current price and will only be filled at or above the current price. Stop orders are the exact opposite of limit orders. These are generally placed on the worst side of the market, and it is the trader's intention to get into the market in the direction of the momentum. Buy stop orders are placed above the market and sell stop orders are placed below the market. An investor with a long position can set a limit order at a price above the current market price to take profit and a stop order below the current market price to attempt to cap the loss on the position. An investor with a short position will set a limit price below the current price as the initial target and also use a stop order above the current price to manage risk. There are no rules that regulate how investors can use stop and limit orders. It is a personal decision because each investor has a different risk tolerance. How do pips, lots and leverage work together? Suppose a trader bought 10,000 euro oblique USD on a 50:1 ratio as discussed in the previous example on leverage. He purchased at 1.30000, then closed the trade by selling at 1.30200. This means that he earned 20 pips. That is 0.001 into US dollars 10,000, which is equal to US $1 per pip. For his 20 pip trade, he would have earned $20. Not all of the pips you earn will be worth $1 US. The value of a pip depends upon the lot size of the trade, how many lots you are trading, the currency pair and your account currency. While you can manually calculate this or use online pip calculators to learn the value of a pip before you trade, most trading applications like the forex trader platform automatically calculate pip values and convert them to the currency you are trading. When a trader trades a standard lot, that is lot size 100,000 with a 50:1 leverage ratio, his earnings will be 0.0001 into 100,000, which is equal to US $10 per pip. So, for his 20 pip trade, he would have earned $200 US. Steps in forex trading. After opening an online forex brokerage account, a trader has to go through the following steps. First, select a currency pair, decide what currency you want to buy and sell. It is very important to consider the economic and political conditions prevailing in a country, as they have a significant impact on exchange rate. Consider the economic scenario that there are reports on a country's economic factors like GDP, employment, inflation, which will have an effect on the value of the country's currency. For example, if the US economy is in a turmoil which can cause the US dollar to weaken, then you may want to sell dollars in exchange for a currency of a country with a strong economic environment. Consider the export potential. If a country has a strong export potential, that is, many of its goods are demanded by the rest of the world, then the country has good money making opportunities. This trading advantage will boost the country's economy, thus boosting the value of its currency. It will be profitable to invest in such a currency. Consider the political environment. During election in a country, its currency will appreciate. If the winner of the election has a fiscally responsible agenda Also, if the government of a country loosens regulations for economic growth, the currency is likely to increase in value. For example, Narendra Modi's win in the 2014 elections in India saw the Indian rupee surge to an 11-month high levels, making it the best performing currency in the Asia Pacific region against the US dollar. Positive sentiments out of the election results contributed to a gain of about 5.3% in the rupee since the start of the year. Second, analyze the market. Traders should regularly look at the current and historical charts, monitor the news for economic announcement, consult indicators, perform other research and analysis activities. Traders can make use of technical analysis. Technical analysis involves reviewing charts or historical price data to predict how the currency will move based on past events. Fundamental analysis. This type of analysis involves looking at a country's economic fundamentals and using this information to influence trading decisions. Sentiment analysis. This type of analysis is very subjective. Traders analyze the mood of the market to figure out if it is bearish or bullish. Although one may not always be sure of market sentiment, one can make a good guess that can influence his or her trade. Third, read the price quotes. Two prices are shown for all currency pairs. One is the price at which you can sell the currency pair. The second is the price at which you can buy the currency pair. The difference between the price at which a currency can be purchased and the price at which it can be sold is called the spread. It is calculated in pips, and this difference is how forex dealers make money. Since they don't charge a commission, spreads will vary among dealers. The difference in spread can be very large, hence traders should spend considerable time in comparing dealers. Fourth, choose your position. Unlike the stock and bond market, because forex trades are buying one currency while selling another at the same time, they can speculate on both up and down movement in the market. Fifth, entering a buy position. Suppose the current price for the euro USD is 1.33820/840. You think that the euro is bullish, so you decide to enter a buy position for one lot of the euro/USD. Because you are buying, your trade is entered at the price of 1.33840 to cover the spread. Now, let us say that later in the day you look at your position and you find that the euro/USD is now at 1.34160/180. Your trade has gained 32 pips. You decide to close your position at the current sell price of 1.34160 and take a profit. Your profit is equal to 0.0032 into 100,000, which is equal to $320. Sixth, enter a sell position. Now, suppose you think that the euro is bearish. You decide to enter a sell position for one lot of euro/USD. Because you are selling, your trade is entered at the price of 1.33820. You look at your position later in the day and discover that the euro/USD is now at 1.34160/180. Your trade has lost 36 pips. You decide to close your position at the current buy price of 1.34180 to cover the spread and accept your losses. So, your loss is equal to 0.0036 into 100,000, which is equal to $360. Arbitrage in the forex market. Meaning of arbitrage. Markets are not always perfectly efficient. In such a situation, there can be discrepancy in the price of some asset at two different places. The result is in arbitrage opportunities for traders. Arbitrage refers to the practice of buying in one market where the price is lower and simultaneously selling in another in order to capitalize on the price difference between two or more markets. The profit being the difference between the market price. This profit is considered to be riskless for the trader. Hence, an arbitrage trader does not bear any market risk. Arbitrage helps to correct the problem of price inefficiencies in the market. For this reason, these opportunities are often available for a very short time before being acted upon. So, arbitrage currency trading requires the availability of real-time pricing quotes. Traders must act quickly to capitalize on such opportunities. To help in finding these opportunities quickly, forex arbitrage calculators are often used. Arbitrage strategies in forex market. Forex arbitrage involves the buying and selling of different currency pairs to exploit pricing inefficiencies. We can better understand arbitrage strategies by studying the following cases. The first case is where we have the following current exchange rates. Euro/INR is 72.54. EUR/USD is 1.09 and USD/INR is 66.65. In this case, a forex trader can buy one standard lot, that is 100,000 euros for 7254,000 INR. The trader can then sell the 100,000 euros for 109,000 USD. The 109,000 US dollars can then be sold for 7264,850 Indian rupees. Hence, through the arbitrage process, the trader makes a profit of 10,850 Indian rupees per standard lot. The arbitrage process will continue until the pricing efficiencies are completely eliminated. Case 2. Arbitrage in the forex futures market. The possibility of pricing discrepancy also arises in case of forex futures market. Suppose the following quotes are available. GBP/USD spot rate is equal to 1.51, 12-month GBP/USD futures contract rate at 1.50, 12-month interest on USD is 1.5% and 12-month interest on GBP is 3%. A financial future is a contract to convert an amount of currency at a time in the future at an agreed rate. Suppose the contract size is 1000 units. So, if you buy one GBP/USD contract today, in 12 months time, you will receive £1000 and give 1500 US dollars in return. The arbitrator thinks that the price of the futures contract is too high. If he sells one contract, he will have to deliver 1000 GBP in 12 months time, and in return he will receive 1500 US dollars. He does the following calculations. To deliver 1000 pounds, the arbitrator needs to deposit 970.87 pounds now for 12 months at 3%. He can borrow in US dollars the amount 1466.01 at 1.5% interest. He can convert this to 970.87 pounds at the spot rate. The cost of the deal is $1466.01 plus $21.99, that is 12 months interest rate calculated at 1.5%, which is equal to $1488. The above deal would create a synthetic futures contract that would convert 1000 pounds to 1488 in dollars in 12-month time. From this, he knows that the 12-month future price should really be 1.488. The market quote is too high, so he does the following trade. Sell one futures contract at the rate of 1.50, create the synthetic futures deal as above. At the end of 12 months under the contract, he delivers 1000 pounds and receives $1500. Using the money, he pays back his loan of $1488, that is $1466.01 plus $21.99 as interest. He makes a riskless profit of $1500 minus 1488, which is $12. Notice that the arbitrator did not take any market risk at all. There was no exchange rate risk, no interest rate risk. The deal was independent of both and the trader knew the profit from the outset. The cash flows are shown in the diagram, where we have sell one GBP USD futures contract at 1.50, then you borrow it, then you convert it, then you repay the loan, and what is it that you get after 12 months. We next come to government intervention in forex market. Each country has a central bank that may intervene in the foreign exchange market to control its currency's value. For example, in the United States, the central bank is the Federal Reserve Bank, or the Fed. The reasons for the government intervention are to To smoothen the exchange rate movement, if speculators are causing too much volatility in the currency market, then the central bank may intervene to smooth the currency movement over time. By reducing the exchange rate uncertainty, the central bank will encourage international trade. To establish implicit exchange rate boundaries, the central bank may intervene to maintain its home currency rate within some unofficial or implicit boundaries. This is done to prevent a currency from falling below or rising above a particular benchmark level. To lessen the impact of temporary disturbances, the central bank may also intervene to counter disorderly market conditions. For example, suppose India exports majority of its goods to country X. Recently, a lot of political disturbances are going on in country X, which has badly hit the Indian exporters. So, in order to prevent the rupee's value from falling, the government may devalue its currency to boost Indian exports. The government therefore intervenes to offset the downward pressure on its currency, in this case the rupee, caused by such temporary disturbances. Types of government intervention. Government intervention can be categorized into two: direct and indirect. Direct intervention. Suppose the rupee is depreciating against the dollar. To strengthen the rupee, the RBI can exchange dollars for rupees, that is buy rupees and sell dollars in the foreign exchange market, putting an upward pressure on the rupee. For example, RBI has been intervening in the currency market since December 2011, when the rupee hit a record low, to stabilize the currency. A weaker currency pushes up the country's import bill. You pay more rupees for the same amount of dollars and contributes to the current account deficit. To push up the rupee, RBI stepped up its dollar sales. Similarly, suppose the rupee is appreciating too much against the dollar. To force the rupee to depreciate, the RBI can intervene directly by exchanging rupee that it holds as reserves for dollars, that is sell rupee and buy dollars in the foreign exchange market. By flooding the market with rupees, the RBI puts a downward pressure on the rupee. An important point to be noted is that the central bank's effectiveness to intervene directly depends to a large extent on the amount of foreign exchange reserves it can use. If the central bank has a low level of reserves, it may not be able to exert much pressure on the currency's value. Market forces would overwhelm intervention actions. Central bank direct intervention is becoming less effective. International financial flows and volumes of foreign exchange transaction now exceed the combined foreign exchange reserves of all central banks. As a result, the number of direct interventions have declined. Direct intervention is of two types. Non-sterilized intervention, when a country's central bank intervenes in the foreign exchange market without adjusting for the change in money supply, it is referred to as non-sterilized intervention. For example, suppose the Chinese yuan is appreciating too much due to the huge volumes of foreign institutional investment and high volumes of export. Too much appreciation in a country's currency can adversely hit its exporters. Hence, the Chinese central bank may intervene to keep its currency value low. To do so, it will start selling Chinese yuan to buy dollars. China is the largest holder of dollar-backed US Treasury paper. Sale of yuan will increase money supply in the Chinese economy and lead to inflation. This type of direct government intervention without adjustments for change in the money supply is known as non-sterilized intervention. Sterilized intervention, when a country's central bank intervenes in the foreign exchange market and simultaneously engages in offsetting transactions in the bond market, it is referred to as sterilized intervention. As a result, the country's money supply remains unchanged. Continuing with the above example, if the increase in money supply leading to rising inflation is viewed as unfavorable for the economy, the Chinese central bank will issue bonds to suck out this excess money supply. Since this type of direct intervention makes adjustment for change in money supply, it is called sterilized intervention. Indirect intervention. The central bank of a country can also affect its currency values indirectly by influencing the factors that determine it. Factors affecting a currency spot rate include relative inflation rate, relative interest rate, relative income levels, government controls, expectation of future exchange rate. Thus, the central bank can influence these variables, which in turn would affect the exchange rate. Government control of interest rates. Consider the following example. If RBI wants the rupee to appreciate, it will hike the interest rate. As a result, foreign investors will transfer funds to India to capitalize on higher interest rates in India. Higher interest rates will also discourage borrowing and control inflation. Increased investment will lead to more demand for rupees and hence put an upward pressure on its value. As a result, the rupee will appreciate. Central banks have commonly raised their interest rates if their country experiences a currency crisis, in order to prevent a major outflow of funds from the country. However, a common problem is that many a times indirect intervention not only fail to prevent the withdrawal of funds, it also increase the financing rate by firms in the country. This can cause the economy to weaken further. Foreign exchange reserves. Forex reserves are foreign currency assets held by the central banks of currency. These assets include monetary gold, special drawing rights, which are SDRs, reserve position in the IMF, marketable securities denominated in foreign currencies like treasury bills, government bonds, corporate bonds, equities and foreign currency loans. The main purpose of holding foreign exchange reserves is to make international payments and hedge against exchange risk. The table which will give us the amount which is available as of November 27th, 2015. It indicates the total reserves, the foreign currency assets, the amount in gold, in SDRs and the reserve position in the IMF. So, what we have is that in the year which starts in November and ends in March 2015, we have the total reserves in US dollar million is 35303.9, out of which foreign currency assets is 36847.0, gold is minus 1046.6, SDRs is minus 261.8, reserve position in the IMF is minus 234.7. Summary. An exchange rate is the rate at which one country's currency can be converted into the other. A decline in a currency's value is referred to as depreciation. Similarly, an increase in a currency's value is referred to as an appreciation. Just like stock trading, there are bulls and bears in the foreign exchange market. A bull market is a market in which prices are rising or are expected to rise. It is characterized by optimism and investor confidence. A bear market is a market in which prices are falling or are expected to fall. It is characterized by pessimism. In a bear market, traders sell to exit the market and minimize losses. 8 most traded currencies in the forex market are the US dollar, the Canadian dollar, the euro, the British pound, the Swiss franc, the New Zealand dollar, Australian dollar and Japanese yen. After opening an online foreign exchange brokerage account, a trader has to go through the following steps: select a currency pair, analyze the market, read the price quotes and choose a position, that is buy or sell. Arbitrage refers to the practice of buying in one market and simultaneously selling in another in order to capitalize on the price difference between two or more markets, the profit being the difference between the market price. The arbitrator earns a riskless profit. Foreign exchange arbitrage involves the buying and selling of different currency pairs to exploit pricing inefficiencies. Each country has a central bank that may intervene in the foreign exchange market to control its currency values. The central banks may intervene to smoothen exchange rate movement, establish implicit exchange rate boundaries, and to lessen the impact of temporary disturbances. Government intervention is of two types: direct and indirect. Foreign exchange reserves are foreign currency assets held by the central bank of countries. These assets include monetary gold, special drawing rights, reserve position in the IMF, and marketable securities denominated in foreign currencies like treasury bills, government bonds, corporate bonds, and equities and foreign currency loans.